market, then primary, secondary. In today's video, we will cover financial assets and instrument. So, let's start. Financial assets and instruments. The third important constituent of Indian financial system is financial instrument assets securities. The financial instruments are also called financial assets because they can earn income for the owner of the assets, that is money or stock or bonds, these kind of financial assets. Classification of financial assets. Marketable assets. Marketable assets are those assets which can be easily marketed, which can be easily transferred from one person to another. Example, shares listed in company, government securities, bonds of public sector, enterprise, etc. There are also some shares, debentures, bonds, government securities, mutual funds unit, trust units. These are the things. Then non-marketable assets. That is, non-marketing assets are those assets which cannot be marketed, which cannot be transferred from one person to another easily. Example, bank deposit, insurance. We can transfer money but not our complete bank deposit. Insurance policy, national savings certificate, provident fund, pension fund, etc. Bank deposits, insurance policies, and company deposit, NC, National Stock Exchange, this kind of a stuff. Then fund-based activity. The traditional services which come under fund-based activities are the following. One, that is underwriting of or investment in shares, debenture, hold, bonds, etc. of new issues, that is primary market activities. Second, dealing in secondary market activities. Third, that is participating in hire purchase is an arrangement for buying expenses consumer goods where the buyer makes an initial down payment and pays the balance plus interest in installment. Money market instrument like commercial papers, certificate of deposit, treasury bills, discount of bills, etc. Fourth one, involving in equipment, leasing, hire purchase, venture capital, seed capital, etc. Dealing in foreign exchange markets activities. These are fund-based activities. We will go detail what are those activities. That is, first one is leasing. Leasing is an arrangement under which the lessor agrees to allow a lease to control the use of identified property, plant or equipment for state of particular period of time in exchange for one or more payments. There are several types of lease destinations which differ in if an entity is the lessee or lessor. The choice for lessee are that a lease can be designated as either finance lease or operating lease. Leasing means giving a building or any equipment or machinery to a company or a person who runs an institution for a particular period, and in which return we get payment. There are several types of lease decision which differ if the entity of the lessor or lessee. The choice for a lessee are that the lease can be designated as either finance lease or an operating lease. Hire purchase. Hire purchase is arrangement for buying expensive consumer goods where the buyer makes an initial down payment and pays the balance plus interest in installment. Example, car. First 20% we first deposit, then 80% loan. Car loans and all, 80% loan plus interest on every installment. Many of you may know this hire purchase. Then consumer credit. Consumer credit is a personal debt taken on a purchase of goods and services. Credit card is one of form of consumer credit. Here, credit card in which there is certain limit or certain credit, how much limit for a credit or a particular card can purchase on credit. That is consumer credit. Bills discounting. Bills discounting or invoice discounting is an act of sourcing working capital for future payables. Furthermore, the seller recover an amount of sales from the financial intermediaries before the due dates. The bills are given and in which the seller recover an amount from the financial intermediate. For the seller use the bills and take financial amount from the financial institution before the due date. This is called bills discounting. Then factoring. It is also important. A factoring is essential a funding source that agrees to pay the company the value of an invoice less discount for commission and fees. Factoring can help the company to improve their short-term cash needs by selling their receivables in terms of foreign injection of cash from the factorial company. Factoring. Selling your invoice to a factorial company, it takes a fees and gives you the cash now and chase your debt. Seller that pays 80% of invoice. See, send goods rise invoice. Then buyer pays the factor, chase later payers. Then factor pays 80% of invoice and value immediately. Insurance. Insurance is a contract, many of you may know, is a contract that represented by a policy in which an individual or entity receives financial protection or reimbursement against the loss from the financial company. A company pools the client risks to make payment for more affordable for the insurance. Insurance we do for many vehicle insurance, then life insurance, fire insurance, marine insurance. This kind of insurance we do only to eliminate the risk if reimbursement of against the loss. If there any loss, if the car met with an accident, then the insurance company will pay certain amount. It helps in reducing the risk. Then this non-fund based activity, we will cover this in our next video, in which there is issue management, merchant management, then credit rating, debt reconstruction, then stock brokering. With this, we will end our today's video. Thank you.